What if the real reason crypto could surge in 2026 has nothing to do with hype, memes, or new blockchains, and everything to do with macro forces like liquidity, interest rates, and capital flows? If you want to understand where crypto is actually heading, this is the conversation you need to hear. Most people approach crypto by watching price charts or following headlines. That's not how institutional investors think. They focus on macro forces. Liquidity conditions, monetary policy, and global capital allocation decisions ultimately determine when risk assets like crypto expand or contract. In this video, you're going to learn how liquidity drives crypto cycles, why interest rates shape risk appetite, how capital flows move before price, and why 2026 could be a critical inflection point for digital assets. This is not about short-term predictions. It's about understanding the framework that drives long-term crypto market behavior. Let's start with the most important variable in financial markets: liquidity. Liquidity is the amount of capital available to move into assets. When liquidity expands, investors take more risk. When liquidity contracts, investors pull back. Crypto is one of the most liquidity-sensitive asset classes in the market. Historically, every major crypto bull market has aligned with periods of expanding global liquidity. That's not coincidence. It's structural. When central banks loosen financial conditions, capital looks for higher returns. Growth assets, speculative assets, and emerging technologies benefit first. Crypto often reacts earlier and more aggressively than traditional markets because it sits at the far end of the risk spectrum. Liquidity cycles are slow. They do not flip overnight. They unfold over multiple years. As we move toward 2026, markets are increasingly positioned for slower economic growth, reduced volatility, and eventual stabilization in financial conditions. When liquidity begins expanding again, crypto historically responds early, before the narrative shifts. Here's the key question for you. Are you watching price, or are you watching liquidity? Now let's talk about interest rates, because rates directly influence risk appetite. When interest rates are high, capital can earn returns in safer instruments. That reduces the incentive to allocate into risk assets like crypto. This is why crypto struggles during tightening cycles. But the most important moment is not when rates are cut. It's when markets anticipate that change. Historically, crypto begins moving before rate cuts happen. Capital reallocates in advance. Investors position themselves for future conditions, not current ones. By the time rate cuts are official, a significant portion of the move is already underway. By 2026, the market is likely operating in a post-tightening environment. That does not mean rates are zero, but it does mean rate volatility declines. When uncertainty around monetary policy decreases, long-duration assets like crypto become more attractive. This transition phase is where crypto tends to outperform. Not when everything feels easy, but when conditions are shifting quietly beneath the surface. One of the most misunderstood concepts in crypto is capital flows. Capital flows lead price, not the other way around. Institutional money does not chase green candles. It enters markets through structured, long-term channels. This includes ETFs, managed funds, and portfolio reallocations. These flows are gradual, persistent, and sticky. Once capital enters these structures, it does not exit quickly during volatility. By 2026, crypto exposure is more normalized within institutional portfolios. Custody infrastructure is mature. Regulatory clarity is improved. Compliance risks are better understood. That lowers friction for capital deployment. Even small allocation changes at the institutional level can have outsized effects on crypto markets due to limited supply and relatively low market depth compared to traditional assets. This is how long-term bull markets are built. Not through hype, but through sustained capital commitment. Here's where many investors get it wrong. They expect immediate results from structural changes. In reality, markets operate with a lag. Infrastructure comes first. Capital follows. Price reacts last. Crypto ETFs, institutional onboarding, and macro alignment do not create instant price explosions. They create foundations. The biggest moves tend to happen after these foundations are already in place. Retail participation always lags macro reality. Confidence increases only after volatility declines and trends become obvious. By the time narratives turn positive, much of the asymmetric opportunity has already passed. This is why understanding macro forces matters. It allows you to position before consensus forms instead of reacting after the fact. Ask yourself this: are you waiting for confirmation, or are you positioning based on structure? So what does all of this mean for you as an investor? It means success in crypto is less about predicting exact tops and bottoms and more about understanding where you are in the macro cycle. Liquidity expansion, rate stabilization, and capital flows create the environment in which crypto thrives. A macro-informed approach emphasizes patience, positioning, and discipline. It prioritizes structure over speculation and long-term alignment over short-term emotion. Let's bring this together. The macro forces driving crypto in 2026 are liquidity expansion, shifting interest rate dynamics, and sustained institutional capital flows. These forces operate quietly and gradually, but their impact is powerful. Crypto does not move because of belief alone. It moves because incentives align and capital reallocates. When liquidity improves, rates stabilize, and capital seeks growth, crypto historically enters its strongest phases. Understanding these forces doesn't guarantee perfect timing, but it gives you a strategic advantage. It allows you to think like capital instead of reacting like the crowd. The question is not whether crypto survives the next cycle. The question is whether you understand what actually drives it. Now I want to hear from you. Do you believe liquidity, rates, and capital flows will be the dominant drivers of crypto in 2026, or do you think innovation and narratives matter more? Leave your perspective in the comments. If this breakdown helped you see the market more clearly, like the video, subscribe for more macro-driven crypto analysis, and turn on notifications so you stay aligned with where capital is moving next.